Good afternoon, and thank you for joining us today. My name is Tim Lee. I'm a research analyst at Red Cloud Securities. I'm delighted to host a Red Cloud webinar on gold exploration and development today. We will hear from Ian Stalker, CEO of Pasofino Gold. During today's webinar, he will provide an overview and outlook. Then we will take questions. You can type your questions into the chat box at any time. We will get to as many as we can. Before we kick things off, first we need to discuss the fine print. During this Pasofino Gold webinar, forward-looking statements may be made. I would direct listeners to the company's forward-looking statements outlined on pages 2 and 3 of Pasofino's corporate presentation that can be found on the company's website, pasofinogold.com. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. And please see our most recent research located on the Red Cloud website for specific disclosures related to Pasofino. So we have Pasofino presenting today. Pasofino's team has a strong background in the mining industry, and they are now focused on exploration and development of the DUGBE gold project in Liberia, an underexplored and underdeveloped jurisdiction. With that, I now turn it over to Ian to update our audience on the company.
Thanks, Tim. That's very kind of you for that introduction. And good, depending where the audience is, good afternoon and good morning to one and all. You'll be glad to know that I have switched my phone off despite that little interruption. So now, fingers crossed, we should be free to go. So, the DUGBE Gold project in Liberia. A very interesting story, I think you'll find. And just to catch your attention up front, this is a project that will become a gold mine. This is not one that's going to go round and round the houses like a lot of projects do. There's a big enough resource in the ground that we already know of. It's a good enough grade and a low enough stripping ratio based on the work that we've done to date on the definitive feasibility study to know that this mine, only 70 kilometers away from the deep water port of Grenville, will be built. And I would suggest to you 2023 is the construction period. So with that, let's move on. You guys will be well aware of the typical disclosures that are used in these presentations. So just quickly, if I can now move on to the summary itself. The investment highlights, just right up front to give you the feel for it, is that we did release a preliminary economic assessment, a PEA, in June of this year. And the feasibility study, which has been running since the end of 2020, will be completed, I think, slightly earlier than we're projecting there. I think it will be done roughly by the end of Q1 2022. The numbers that we have put out, which I know we will not only confirm but hopefully improve upon in terms of the feasibility study versus the PEA, highlight that we have a production profile over a 14-year life of mine of 188,000 ounces, and the cost in terms of all-in sustaining circa $800 an ounce. So really attractive numbers, nice production profile, and a long life of mine at the moment sitting at 14 years. The asset itself, one of the things that I've learned in the mining industry and over the years, if you want to have a project that makes sense for the long term, you need to have bulk. And this is a large scale asset. We already have, in terms of 43101 compliant resources, 2.3 million ounces at 1.51 grams per ton indicated, and 1.3 in the inferred category at just below 1.5 grams a ton. And both deposits remain open for expansion. And in fact, we'll talk a bit about that. The exploration upside associated with our company is large. We have, as you can see there, almost 2,600 square kilometers of ground. So this is a real gold province that we've got ourselves involved in. And over $85 million has been spent in the project to date. US, in fact, it's now closer to the 100 million with the money that we spent. And so there's a huge amount of data and information that's driven us to move forward with this feasibility study. We'll talk about the team, and we'll talk about Liberia rather than spend time at this moment. I'll come up again. The team itself, I'm the president and CEO. John Saunders is the COO and a director, and Lincoln Greenidge is our CFO. We also have a back team of geologists and mining engineers and metallurgists, of course. And I would tell you every one of them has African experience. I myself was in West Africa for 11 years, starting with Ashanti Goldfields and taking that little company at the time from 100,000 ounces to over 1 million ounces per year from the company. And so I built projects in Namibia, in Guinea, in Tanzania, and in, of course, Ghana itself. So I am familiar with the West African background, and I do have a little bit of background in taking projects through from the feasibility study into the construction and then into the operational zone. So does John, and Lincoln has been with us as well. So we've got a strong team. And the other thing just to mention at this stage, for those who may or may not know, I won't take too long. I have been involved also in the junior side of things with several companies that have realized significant value for the shareholders. And the one the gold buffs will be more familiar with recently is K92 out of Papua New Guinea. I was a founder of K92 and was instrumental in bringing it into our stable in 2014, and we've taken that little company now, as you know, to be a significant producer and with a huge growth story and a market cap of over 2 billion Canadian dollars. So nice success, recent success in the gold mining, but we've also been involved in uranium. We've been involved in lithium and taken juniors and sold them and moved forward with return to investors. With that said, key takeaways. Remember, I said a lot of money spent in the ground, so we've got an extensive database that has helped us focus on the main project to begin with. But as we get over that main project, then you can start to look at regional development in a sensible and pragmatic way. Because of that work, we can move the project quickly through to the construction phase, as I mentioned. I think that'll be sometime towards the middle, maybe even late of 2022, and therefore be in operation in 2023. Significance of it, to me, having done a lot of African projects, is that we are only 70 kilometers away from the deep water port of Granville, and that makes operations not just slightly easier in terms of access, but it's cheaper. So by a comparison to, say, a peer group of the guys working elsewhere in West Africa, we would probably have a cost saving just in OPEX alone of plus or minus 10%, because there is limited freight forwarding costs and handling costs and time associated with it. And it means that we don't keep such a large volume of spares on site because we can access support much quickly. Okay, moving on. This is where we are in Liberia. I wanted just to take 2 minutes of your time to mention Liberia to you. Small country on the west coast, hardly been touched in terms of exploration, which is both good and bad. People don't know of it because it's not been touched, but it's good because there's fresh resources and new information coming out all the time in it. But it does have a history of mining. Predominantly iron ore mining has been there for some considerable time, and it's the ArcelorMittal group that's been running there and have in fact indicated they're going to spend $800 million in improving that mine as well as the infrastructure associated with it. We will be the second gold mine in the country. The first one was Liberty Mine that came about in 2013. So the guys understand mining and they're very keen to promote it. We'll see that demonstrated when I talk about the Mineral Development Agreement, the MDA, that will come up in a minute or two as well. Country is 4.7 million. It's all English speaking in it. Predominantly, a lot of the independence came back in not last century, but the century before last. A lot of freed American slaves went over there. That was where they were repatriated to. So the country has been very stable, very calm. Had a first female elected head of state ever in Africa with Ellen Johnson Sirleaf, and she's been replaced via the democratic process with a new president called George Weah, who is a pretty well-known soccer specialist in actual fact. But the country's quiet, calm. It's got one main religion, which happens to be Christian in this case. And so the dramas that constantly we see in the Burkina Fasos and Malis, and even in the Cote d'Ivoire, the northern part of Cote d'Ivoire and Guinea, we don't see. It's a very calm, very stable environment, and hence very good for investment. The DUGBE project area, well, it's one of the last untouched Birimian areas in West Africa. In this particular slide, you can see the range of endowments that exist in countries near us. For Ghana, for Burkina Faso, 200 million in Ghana. Burkina's got over 60 million ounces and so on and so forth. So at the moment, with only 16 million in a much bigger footprint, you can see what the opportunity is in terms of the endowment that could be there and the prospective area in which we're working. Excuse me. The government agreed with the company back in 2019 on what was then known as the Mineral Development Agreement. It was passed into law and therefore is law by statute. 25 years period of time, long-term stabilisation of taxes and duties, agreed royalty rate of 3%, and of course the standard West African 10% free carry, income tax, so a corporate tax, 25%, so it's not aggressive. Established community development fund, and I think importantly, just to highlight, the government went out of its way to agree with us that in the event the cost of gold was to drop to $1,500 or below, and I don't see that happening in the short term, I have to tell you, but if it did, then the government has agreed to reduce their fuel tax by upwards of 75% for the first 5 years of production, and thereafter by 50%. So we have a nice insurance, and it's not just the sweetness of having that insurance. What's important, I think, is the message is that the government wants this mine to be built. And so we get good cooperation from a relatively small country, not in the headlights in terms of the typical troubles, as I mentioned, next door in Mali and Burkina Faso, but willing to get moving. And so we think we're in a good country, good project, and a good opportunity in what is a positive gold market, and remains so. Here's what we've got. We mentioned the ounces. We'll come back to that in a minute. 188,000 ounces a year production, straightforward processing and compelling economics that we'll come up to. We have an agreement. We have 49% of the project, and at the completion of the DFS, we should be very clear that the remaining 51% will be put into Pasofino, and Pasofino will be the 100% owner of the project. For that 51%, obviously, they will get equity appropriate at that time. But the project under our operating team will be fully immersed into Pasofino. We mentioned the exploration upside. Again, we'll touch on it as we go forward, but we have huge opportunity. Here's what the initial numbers look like, and it really is quite attractive. We've talked about a 5 million ton per year operation, producing roughly 2.5 million ounces over a 14-year life of mine. Production can range, it's over 226,000 in some of the earlier years, and on average it's 190,000 ounces. So a good level of production. It's an attractive number to get into the marketplace. Low stripping ratio, initially 2.8 to 1 for the first 4 years, and over life of mine it's actually turning out now to be less than 4.5 to 1. Power costs at 18 cents per kilowatt hour, but real opportunities of saving significant value there as we move forward in the study. And we've a long community support. We've got a capital requirement of 391 to produce this 5 million ton per year operation, and the huge opportunities we've mentioned in terms of increasing the amount of ounces that's available to us, which we would take out predominantly from the cash flow rather than looking for fresh money, etc. It just doesn't make sense to be diluting any further than we have to the company's investment base. So looking at the financial matrix, you can see there that at a $1,600 gold price, and everything I'm reading tells me that we're in a fairly stable, at least 1,800 gold environment for some time to come. Even long-term projections are hanging around from 2025 at 1,700. But on a 1,600 gold price, you can see there we have an NPV of 825 million, which generates 627 million post-tax. That gives us a 34% IRR and 2.8 years capital payback. It will be even less than that, gentlemen. And life of mine cash flow, as I mentioned, 627. All-in sustaining costs, less than 900, and cash costs, 821. So I'm sure you'll agree with me when you say the project is very attractive. It's got the right levels of costs and capital that can see us as a junior company building this. So this will be a new mine in 2023. We have huge exploration potential. We mentioned the size of the permit area we've got. Only 4 targets have been drilled to date. We've concentrated on the existing resource area where we wanted to bring in a lot of the inferred resources into the measured and indicated, but we've also found when we've been doing that some step out targets from them, and we see the opportunity for resource growth. But there's a huge amount of targets that are out there, and we will, I can tell you, in the years to come, be finding a lot more gold in this part of West Africa, in the country known as Liberia. The DUGBE deposit, this is just a snapshot of it there. Recent drilling that we've completed. You can see it's almost 7,000 meters of infill. So that MRE, Mineral Resource Estimate, is being upgraded. It'll be out along with the DUGBE one, which is the second resource we've got. DUGBE and Tucson all form part of the one project, 4 kilometers apart. Both of them will be out by the end of this month, the month of September. And we will see a significant conversion of the inferred into the indicated, and I believe a reasonable growth in terms of the ounces we've found, because we have found some nice thicker zones in some of the folds that weren't previously identified. And as you can see there on the snapshot, some decent looking grades. So 1.51 is our head grade on the project, which is by comparison one of the best in Africa. Key advantages of DUGBE itself in terms of the deposit, as you can see from this particular cutaway, is it's long and wide, shallow and simple gently dipping sheet that makes it easy for open pit operation, very close to the Tucson deposit that we'll talk about in a minute, and excellent continuity for continuation of further growth in it. So we're happy with the DUGBE and we're happy with the Tucson deposit. There will be a press release coming out probably next week, I think, on the next set of 12 holes coming out from Tucson, and that's highlighted the opportunity of stepping along from the known mineralization, so some more ounces there, and some of the info we've been getting are highlighting grades not dissimilar to what you see in there, but some of them are, I can tell you, 7-8 meters at 2.5 grams a ton. And there's one large one I know, it's 57 meters at 1.98. So nice, solid, thick intersections, lends itself to open pittable, and will be reducing the overall stripping ratio that we talked about earlier on. So both Tucson and DUGBE remain open for expansion. Extensive greater than 2 gram per ton zone that we've talked about, and the new MRE for both of them will be out by September, the end of September this year. We have other targets. One of them we like is Bucon Jeddah, and the reason we like that is not because there's artisanal mining, but because artisanal miners are taking out some higher grade gold, higher grade than what we normally see in our mineralized style in both Tucson and DUGBE. That's about 6 kilometers away from our current mine projection site. And later on this year, maybe the early part of next year, we will go in there and do some drilling. But that's a higher grade gold target, which, you know, all of us like high grade. K92 is particularly sweet when it comes to that comparison. So I'll take any high grade I can get in this project. Other targets that we will be drilling this month of September is the step out from Tucson. I'm just going to highlight that in white at the moment, guys, if I may. It's this area down here where we've got the comparison of, or the continuation of Tucson heading towards one of our other known deposits, Saccor, and we've had some really good indication of trenching results, some that will come out in a press release shortly. So we will be sticking in there probably about 4 or 5 holes in the next 4 weeks or so. So we're excited that there's still more growth to come immediately, but longer term, well, I say longer term, medium term, significant extra growth. The project itself, guys, why I wanted to take you through this particular slide is you can see the Grenville Port. That is an unusual benefit for any gold mining project, any mining project for that matter. It's got deep water facilities. It's not congested, as you can see. It's got good access to the mine, 70 kilometers, of which 40 of it is tarred. We've been working on the roads, and we have spent 3 million of our money that we raised earlier in the year on that road, so we've got good access at the moment. Port is handy, it's close. Power, one of the things I wanted just to highlight in the power, we used 18 cents in the study to date. That will be updated in the definitive study, and remember, I'm just confirming the definitive study will be finished in the early part of next year. But we have negotiations underway with the government because there is an opportunity of hydropower being generated in the area. Studies were done independently by the government of Liberia, and they've highlighted by professional engineering groups such as Knight Piésold, whom some of you will be familiar with, that power can be generated somewhere between 4 and 5 cents per kilowatt hour. So you can see the potential saving that comes into OPEX, and we would be happy to be a customer of the private power producer that would work in that. So we have a memorandum of understanding with the government that highlights, again, this ability to work in Liberia and work comfortably with the government, that we are now progressing that as a joint effort with the government going forward. An environmental impact was done previously in 2015. We're updating that using SRK out of the UK, a well-known name in terms of the environmental business. So no stone literally will be left unturned to make sure that we have complied with the top levels of environmental standards worldwide. In the royalty side, of course, there's the government royalty going forward. That's the schedule that we've put together. Exploration drilling to all extents and purposes is completed for this moment in time. MRE updates will be completed by the end of September. The social and environmental impact work will be completed by the first quarter of 2022, expecting approval in the second quarter to lead us forward to the construction I've talked about. And the feasibility study is well in hand, highlighting some real opportunities, both in met recovery, etc., that was previously used, as well as operational costs and some benefits associated with the way tailing storage is handled going forward. So we will complete that, I believe, by end of March, early April next year. We took the time to make sure social and environmental responsibility was identified. SRK, as I mentioned, have been the guys running it. We do have the agreement, the social agreement with the people at the moment in time, both the government and local communities. Money has been spent, and we have a very calm environment to work in, and we have given an indication of the way we will go about our work going forward, and that's been well received by the people within the communities themselves. Study update, metallurgical test work program has just been completed in Australia. There's an opportunity of adding 1, maybe 2% to the recovery, which is always a bonus. Infrastructure work has been completed in the areas. The geotech work will be finished within the next 3 to 4 weeks. And I'm looking for an opportunity for obviously steepening up the pit slopes. If we can do that, then obviously that stripping ratio, which is already a benign sort of 4:1, will come down even further. I've mentioned the power, I've mentioned the environmental impact assessment work, where we're really working hard to be at the top level of it. And so we're making progress to ensure that the study is complete by the end of the first quarter next year. In terms of the company itself, we have 31 million shares outstanding, giving us a rough market cap of about 30 million Canadian. So you can convert that as necessary to US. We've got 4 million options out there, none of them at the moment in the money, but hopefully in the future there will be. And therefore we've totally diluted shares of about 36 million. We still have $3 million of money, Canadian dollars, in the bank, so we're in fair shape in the immediate future. But I've no doubt at some stage, like every junior, we will go out and raise a little bit more money at the opportune time. But the main thing I think to recognize, gentlemen, and although I can't show it, I'm sure you can have discussions with whoever you want offline, is that if you look at our overall value, where we have attributable to us 2 million ounces, and then we have what's known as an enterprise value per total ounce of $11 per ounce, and that compares with the industry standard for projects like ours in West Africa, like ours in South America, perhaps nowhere near the grade, and nowhere near the potential stripping ratio or the capital costs. We are trading about circa 1/4 of the enterprise value of our peer group. So that, again, from an investment point of view, it's not only the project that's attractive and the production profile that's attractive, the ability to deliver it in a reasonably calm part of the world where you can see construction taking place, but it's also to highlight that from an investment point of view, right now, we are trading well below our peer group. And we will move that value up as we go forward. So it's a great time to get in and take a position in the company and see the future with us going forward. And guys, that's my story. Thanks very much, Tim.
Absolutely. Thank you very much, Ian, for a very informative presentation. We'll now start the Q&A portion of the webinar. A reminder to everyone on the line that you can type your questions into the chat box at any time. We already do have a couple of questions here. First, and you had just kind of addressed this, but are you, I guess, are you fully funded to DFS, to the feasibility completion? If not, how much additional capital do you need to raise to get there?
I would be honest and tell you that I think another sort of $3-4 million would be appropriate. It gives me a little bit more ammunition. For example, if we got the exploration work that we're undertaking as well as the definitive study work, and it came back with a success, we'd want to stick a few more holes into it. And I wouldn't want to be constrained just keeping my money for DFS. So a further $3 to $4 million would be an appropriate raise if we go forward.
Great. And one question, could you explain further the project ownership structure? Who owns the other 51% of the project, and how does the government ownership work?
Okay, the government ownership is a standard West African free carry. So they have 10% of the project, and they do not contribute anything except the ability to work within the country, which is a huge thing anyway, and the ability to work within the communities where they're working very hard with us line for line. So it's a standard West African 10% free carry. The project was previously owned by Hummingbird out of the UK. And it was those guys that had spent the $80-odd million in the earlier part of 2005 to 2015. They unfortunately got their timing wrong in terms of the gold market, and this project went into the sort of back burner stage while they concentrated on a smaller project in Mali. And with hindsight, maybe they now feel they shouldn't have gone to Mali, but that's another thing altogether, with the dramas that are unfolding around that part of the world. But we saw the opportunity for Pasofino to collect this project, and we created circumstances where we took 49% out of Hummingbird. We did that by agreeing to spend money in the ground and the feasibility study. So nothing was paid as such. I think there was a $2 million transfer to get what's called as the Golden Donut, which is an area of ground that we wanted to pick up anyway within the project boundaries. But the agreement was that at the end of the definitive feasibility study, so by March, April next year, on completion of it and highlighting obviously it's a successful project, and we know from the PEA it is, and the definitive study will just emphasize that further, and then Hummingbird puts their 51% remaining into the Pasofino vehicle, and Pasofino becomes the 100% owner of the project, and equity is dispersed as a consequence. And that's the structure of it.
Okay, great. Okay, yeah, we did have one additional question on how does the buyout to 100% work, but basically you have just explained.
Hopefully that covers it. Yeah, hopefully that covers it. And it's a given. It's cast. It's legal. They cannot. There's no wiggle room. We will become the 100% owners.
Great. And one kind of follow up to that, we did have one person ask. So the 51%, do the newcomers in Pasofino have a chance to make money at all? I guess was the question.
I think so. Look, I'm an investor in it myself. Management and insiders probably have 25+% of the company. We followed our money at the last raise, and in any future raise, I can assure the guys listening to this that we will also follow our money. And the reason is that at $11 per enterprise value per ounce, compared to the peer group of 42, when in fact we've got better ounces, higher grade, lower stripping ratio, in a much more workable environment in West Africa than the vast majority of our competitors out there, then I can't see any reason why this will not sooner rather than later get traction and see value accrete for all of us.
Great. Did have one question about the reverse split or share consolidation that happened recently. What are your thoughts on it in retrospect? The stock is dropping in price, but I guess it seems like quite often.
Yeah, look, the market's not been favorable, I don't think, for gold mining companies in general, maybe apart from one or two of the seniors. I think most guys have suffered. I can look at a range of companies, and some of which I'm invested in because I'm a believer in gold anyway. Our little consolidation took us on a 14-to-1 basis to get us a better value. We're trading today circa 91, 92 cents. I think when we converted, we were at 106. So we have come down a little bit, but not significantly. And the volumes aren't great. The bulk of the people are saying, I'm holding this until we start seeing some positive accretion here. So there's no big sellers in the marketplace. And the market tells you what it thinks of you, and you just have to make sure the market understands you fully. And that's what we're doing today.
Great. And you had to explain this, but I did have one more question here submitted on the buy-in. Is the buy-in price for the 51% fixed? And
no, that's a good question. It'll be related to the market value at that time.
Okay, great. Great. And one question here that's more on the general corporate strategy side. Long term, what is the strategy for the company? Do you want to become a gold mining company or develop the project and sell to a producer?
I think we have to keep both options on the table. and we're doing so. I am quite comfortable that we can put a mine together here, and I honestly believe it will be built in 2023. So it's only just round the corner. But at that kind of production level of 190 to 210,000 ounces a year, it obviously has attraction for some of the guys who want to be big miners with the West African or worldwide for that matter. So do I see it catching people's attention? At an all-in sustaining cost below $900 an ounce, it will catch attention with that production profile. And Liberia is a good country to be in. When I first went to Ghana, just in passing, we had one mine really. It was just Ashanti Goldfields, and we had no mining contractors. We had no supply of equipment. I used to go through the waste dump looking for mill balls just to keep the mill going. But now Ghana's regarded as a beacon of stability, a real good country to invest in. I think Liberia will follow the same path, but it's got to get the work in the ground done and the mine built. But it will follow it because it is a good country to be in.
Great. One question on looking forward on the financing side. What challenges do you foresee in getting funding for construction? Any initial discussions with lenders right now?
No, not yet. I think we want to get the feasibility study finished. I expect as the study comes to a conclusion, first quarter next year, those discussions will be held. There's royalties. Everyone knows the options out there. There's royalty, there's debt, there's equity. K92 happened to go to debt at the time. I found a New York house. It was a private equity, wanted to put money in. Those guys gave us 10 million Canadian, if I remember correctly, in K92. And for that debt, we gave them 25% of our gold production for a certain number of ounces. And I would think the guys were very happy with the end result in that. So the same with this one. We will look at debt, we will look at equity, we will look at royalty, and obviously we'll make the best decision for investors going forward as a consequence of those deliberations.
Great. One kind of general review, I guess, but just to review, what news would we expect to have over the coming weeks and months from Pasofino?
We would have news coming up in terms of the latest drill results from Tucson. That's one of the two deposits. We've already put out the DUGBE ones. Tucson's coming out. That will be followed up by the MREs, the mineral resource evaluations that are completed, and they'll be done by the end of September. That will then be followed up with some of the trenching results we've got, and then the drilling results as a consequence of that trenching in that area between Tucson and Sakor, where we believe the mineralization continues close to surface. So it's effectively an extension of the same Tucson pit. And then, of course, as we move forward into the feasibility study, there'll be a series in the early part, I think, of end of this year, beginning of next year, of press releases coming out, just bringing everyone up to date as to how the numbers are looking and how we're finishing off the study in terms of a va-va-voom and a bang, bang, bang.
Great. Great. And I guess one other review of what work, what work is still going on into the feasibility study? What kind of areas are there to optimize, and I guess what are, metallurgically or different areas? What are you looking at in that way?
All right. Well, look, the MRE is converting the bulk of the inferred into the measured and indicated, then allows us to undertake the detailed mining study. And it's not much different from what we've already done, because we anticipated most of the inferred going in, and it will go into the indicated category. But that allows us then to convert those measured and indicated ounces into reserves properly, which will form part of the study. So the mining side is moving forward very, very well, and I'm not expecting major changes as to what we've previously done, because it's based on the same information. Metallurgically, we've been looking at the opportunity of picking up some grade recovery benefits, and so we've been doing some finer grinding, which is just a process trade-off against power, and we can get maybe 2%, maybe 3% increase in that. And parallel to that, of course, is the operational benefits of bringing in the hydropower plant. I don't think it will be immediately available, and we'll start anyway with the diesel generated, which will become, if you like, then the standby power going forward, which is always handy. But if we can get the power plant to deliver 4 4 cents per kilowatt hour, then those operating costs that I referred to, the sub 900 all-in sustaining and the sort of 800 circa cash cost, they're heading closer to the 800 level themselves, basic cost numbers. So you can see 800 versus an $1,800 gold price. Every ounce you make, you're making $1,000, and you're going to make 200,000 ounces a year. So it's a decent little cash flow. And it becomes an attraction. And that goes back to your earlier question, what happens to it? Well, we will certainly make every effort to build it, but whether it will remain for us to build it or someone else, it will be built, that's for sure.
Great. And one quick question, obviously it was on the slide, you had mentioned it, but what is the current resource? Where does it stand now?
We are, and we're not allowed to combine the measured and indicated with inferred. So 2.3 million of measured and indicated, 1.3 of inferred. And I'm hopeful that we'll pick up 200,000 or 300,000 extra ounces as well as doing the conversion numbers when we complete the MREs.
Great. And then obviously open-ended with some additional exploration potential on the large.
Correct. I think so. We'll make sure it still looks sexy in terms of the exploration. We know how to do that. I'm sure as every good CEO knows how to do. Absolutely.
Great. And I guess one general question on Liberia. You have mentioned obviously it's a jurisdiction that's become stable, but what insights can you give on that way? Because obviously it did have a rocky past.
Look, its rocky past was limited to what was known as the Diamond Wars, and of course. A couple of Hollywood actors made it fairly famous as a consequence of the movies that came out. But it's never been unstable as a country in general terms. It has been relatively quiet. Whereas Ghana, it was the coup d'etat center of West Africa. When I arrived in Ghana, they coup d'etats every year. And people now coming into the mining industry think Ghana is quite a stable country. Well, it was stable because Jerry Rawlings at the time got rid of quite a lot of his opposition opponents very comfortably, shall we say. So Liberia has not been like that. And that the fact that the population is predominantly single religion, and it happens to be Christian, it's just one of those things, means that you don't get the rifts that you see in other countries where poverty and division amongst groups, whether it's religious or otherwise, allows terrorist people to invest themselves in the area and create instability. So by comparison, Liberia is good. I know one of your colleagues, if I can quote him in this podcast in Red Cloud, tells me that not only is he's a big football supporter, he's an Italian, so you probably know who I'm talking about. He knows George Weah, the president, personally. I can pick up the phone to him and enjoys talking with him because Weah was a big soccer fan and a big soccer player. But his claim to fame from your group is that it's one of the best beef burgers in West Africa. So he regards that as pretty important.
Oh, yeah. So one other question, kind of circling back here, but it was a follow-up question on the resource. Is the grade based on a low all-in sustaining or AISC, or I guess what is the base? What is the resource?
It's another good question. It was a 0.5 gram per ton cutoff. It was based on, which is based on economic factors, including the cost of mining, cost of metallurgical processing, and the G&A. So if we reduce that in a better gold price, then we would pick up very quickly quite a quantum of grade at 0.4. I think if I remember correctly, it's about 250,000 ounces sitting between the 0.4 and the 0.5 basket. And then if you go to 0.3, you pick up another 200,000 ounces. So, the gold price does have an impact on how many ounces you can put through. And the more of those ounces you put through, of course, remember the stripping ratio decreases as well, because that is regarded, the low cutoff grade material is regarded as waste.
Great. And then one question here, kind of going back across the pond, and obviously the focus has shifted to Liberia, but does the Roger project in Quebec still have some promise, or what's in store there?
All right. No, look, just to bring everyone up to date, we did have a project in Quebec, and it was called the Roger Project, or Roger, depending on which accent you wish to use. But we sold it roughly about a month and a half, 2 months ago, and we picked up a decent amount of cash for it and some shares in the company as an added benefit. We still have those shares which we could sell, and the company's doing okay. We regard it as not being critical for the Pasofino's future. It was relatively small in Quebec, small footprint, and it would have formed automatically and naturally part of a consolidation. So we took that opportunity 2 months ago to pick up some good cash in a positive market.
Great. Well, unless there are any other questions, we had some good interest here today, and I'd like to thank you again, Ian, for the presentation today. I think people out there, our listeners found it quite interesting, and thank you everyone out there for tuning in today. Just a reminder that Red Cloud Securities will be back next Tuesday when our webinar series continues as we present MineHub technologies at noon Eastern time. And everyone have a great day.
Yeah, thank you very much. Good. Best wishes to everyone. Thanks.